Hello and welcome to a special live edition of Economics. A few hours back, Finance Minister Nirmala Sitharaman tabled the Economic Survey 2021-22 in Parliament. The Economic Survey is a report card put together by the Chief Economic Advisor for the government to be tabled in Parliament one day before the budget is presented. But this time, since there was no Chief Economic Advisor, it was done by Principal Economic Advisor Sanjeev Sanyal. It's a document which is closely watched for because it is the government's assessment of the economy. Whether you want to believe how much the government places in front of Parliament or how seriously you want to take it, you cannot dismiss it because there are serious data analysis, data crunching, and forecasts in that economic survey. The big headline from this time's economic survey is that India will grow between 8 and 8.5% in the next financial year, which begins on 1st of April, that is 2022-2023. Hi, Ila. So this is a special episode we are doing today, and we are only going to talk about 5 key takeaways from the economic survey, which was presented in Parliament today. And the first one I already mentioned as the big headline number. India will clock 8 to 8.5% growth in 2022-23. It's already being talked of as a conservative number because all the other agencies, IMF, World Bank, RBI, have all NSO have put it above 9%. So, where do you think this conservative number is coming from? Although it will still be the fastest growing economy in the world.
YP, before I answer your question, let me first congratulate the team that brought out the survey. I want to, especially congratulate Principal Economic Advisor Sanjeev Sanyal, because I think this exactly is what an economic survey should be, and not a full volume on the thoughts of one individual, because it is an economic survey of the government of India. Now, other than the forecast, which is done by one department within the Ministry of Finance, the rest of the survey and every single line and every single number comes from different ministries. The DEA asks for, this is what we want to cover, and if there are any other special things that you want to write in the survey, and then every line, every sentence, every number comes from data from across the government, from financial regulators, so SEBI, RBI, and different ministries. And so this is an economic survey of the government of India as brought out, as seen by the government. So I really, I think this is what it should be. And that I hope this is the format that the new Chief Economic Advisor, who's just taken charge this week, should be following. So, kudos to Sanyal and his team for having done the right thing and sticking to the right thing on what a survey should be. Now, to come to his numbers, you see the number of next year's growth depend on your number for this year's growth. So if you, and both are estimates. So you've got advanced estimates for 21-22 at 9.2. Then you make estimates based on that for 22-23. Now think about if you're making these estimates, not in terms of growth rates, but in terms of levels. Suppose it was in real GDP numbers. So nominal GDP deflated to real GDP numbers. Then it could well be that many of the other forecasting agencies would have had a little lower number for 21-22, because of which the growth rate for 22-23 is faster than what Sanyal's growth rate is. So the real thing to compare is not just next year's number and whether 8 to 8.5 is high or not, but whether this trajectory of the levels that are forecasted by, so models forecast levels, not growth rates. So when they forecast levels, we look at what is it this year and then what is it next year. And then, of course, depending on where you think the growth is. So if you thought that growth was further slowed down, if the ministry and another agency have similar numbers for 2 years, but then the ministry sees Omicron and the reduction in service sector in Omicron in this period and slows that down, then next year's number go up.
Consumer price index inflation. The survey talks about CPI inflation which was 5.6% in December, is well within a targeted tolerance band. Is that an indication that this is the kind of inflation the government is expecting for much of the next financial year?
I don't think so, because I think that the survey also expresses concerns about imported inflation. So when they talk about imported inflation, they are clearly expressing concern. Otherwise, they wouldn't talk about it being that we are importing inflation. And my sense is, in another place, for example, when the survey talks about withdrawal of central bank liquidity, then that is again an indication that levels of inflation across the world are high, and that is why central banks, so we know about the Fed, that it might actually do more aggressive withdrawal of liquidity than we thought, or it might raise interest rates. The Bank of England is also expected to raise interest rates aggressively now. So there is an understanding that across the world inflation has gone up, and I think that though they don't say it very clearly, but the concern about higher inflation and higher imported inflation is there.
The principal, I'm sorry, I keep going back to the CEA, it is the PEA, talks of something called the Agile approach, and that's our third key takeaway. One of the, and I will quote, from or paraphrase from the survey, one of the reasons that the Indian economy is in a good position is its unique response strategy. Rather than pre-commit to a rigid response, the government of India opted to use safety nets for vulnerable sections on one hand. And he talks of this as being an agile approach, and you keep changing your strategy as things change. Can you explain that as the third takeaway, Ila?
So I think these 2 years of the pandemic have been extremely hard, and there has been a lot of uncertainty for policymakers. So policymakers, if they start saying, okay, now we are doing this huge, so one option could have been that right in the beginning, policymakers had said we will do a huge demand revival by doing fiscal and monetary expansion, and that's kind of where all our resources will be spent. And as that would have assumed that there was only one wave of COVID going to happen. And then after that, the government would have run out of ammunition. I think what Sanjeev Sanyal here is referring to is the fact that the government did not use up its entire ammunition, and that it said, okay, let's wait and watch, because the pandemic is something we've never seen anything the likes of before. Yeah. So let's try to see if we, what we need to do. Let's hold some ammunition. Let's respond to the situation as it develops. And what we did see actually in these 2 years was that, the second wave came, and then a third wave came, and let's hope there's no other wave. But every time one wave finished, we always hoped that there was no other wave coming. But I think keeping policy options open, not using up its entire ammunition, not committing to a path of 10% of fiscal deficit spending regardless of anything else, and trying to do a demand push in a situation where there were supply constraints. Those are the kind of things that the government did, and that are being described as an agile strategy.
That's agile is a new word for those of us who are not students of economics, maybe, but agile is a word we all understand. The fourth takeaway, or I would call it interpretation, Ila, is that because of the fact that tax revenues are buoyant, there seems to be an indication that there is room for fiscal spending, and the budget tomorrow is likely to announce a lot of such expansionary investment measures. Is that our fourth takeaway?
So he says the economic survey says in one place that tax revenues have grown by 67%. And that means that there is fiscal space for expansion. Okay, so there will be space for further action that is there. Now, when it comes to, does this mean the budget will do X, Y, and Z? YP, for the last 20 years, the survey and the budget kind of go in different directions. While the survey can tell you about what has happened, second, the survey may also broadly talk about some of the things that are concerns of the government. And so look forward to the next, 5-10 years as something that this is what the government is thinking about. Very, very rarely is there a one-to-one correlation between the survey and the budget next day, because these are worked on by two different teams. The budget team is in the budget division, and the Department of Economic Affairs does the survey. And actually, there are walls between these two teams. I mean, other than the chief economic advisor who attends both meetings, there are walls there. So rarely do we see a direct translation. But of course, in this context, that there is space, and so you may see some further expansion. I mean, already expansion is being expected on CapEx, that private investment is a way not just to push up demand, but also to ease supply constraints and to create an environment where private investment will get attracted more. There is an emphasis on private investment. Even today, there has been another disinvestment that has been announced. And this sort of an emphasis is likely to continue. The emphasis on CapEx and on investment in public infrastructure is likely to continue.
And that will obviously have a lot of spin-offs in terms of growth and job creation. The last takeaway, the fifth takeaway, is the conclusion or the summary, the optimistic note with which the economic survey concludes. It says, the macroeconomic stability indicators suggest that the Indian economy is well placed to face the challenges of 2022-23. Would you agree with that?
So you see, there are many challenges. There is a challenge of growth, which has to get back to pre-pandemic levels. And that will happen if we don't get another wave of COVID. Then there is a challenge of inflation. And inflation is, a lot of it is imported inflation, and a lot of it is because of supply constraints, and a lot of it is because we have had easy monetary policies, and globally easy monetary and easy fiscal policies. So when you think of GDP growth, when you think of inflation, and third, when you think of macro stability, is current account deficit. Now, when you think of the current account deficit, yes, it went into surplus, and then it went back into a little bit of a deficit because imports have grown faster than exports have grown. Now, if Omicron has dampened the growth of world trade and exports, and it continues to do so, then that will remain a challenge. And along with that is the fourth challenge, that global, particularly the US and advanced economy, G10 economies, their policies, fiscal and monetary policies, are likely to become contractionary. Certainly, monetary policy is likely to be contractionary. And whenever that happens, you get this risk-off phenomena where capital flows out of emerging economies. So when you think of our current account deficit and the stability of the rupee, then that has been there partly because of the low current account deficit, or where it was in surplus, and now even though imports are rising, it's low enough that capital is flowing in to compensate for the demand for rupee. If you see a reversal of capital flows, and if exports fail to pick up, then that could be an area of concern. So these three, GDP growth, which depends on COVID, imported inflation, which depends a lot on imported inflation, and reversal of particularly monetary policy and central bank liquidity across the world, which could reverse capital flows into India, could actually impact the rupee. Now, what the government has to do and what the RBI has to do is to be calm. I know we've been saying that all along, but want to repeat this, don't panic, be calm. Even if the rupee moves, it's happening at a time when you don't your exports could do well by becoming more competitive.
Mhm.
So yes, it will not balance sheets and corporate balance sheets of those who have borrowed in dollars, they won't be very happy about it. But the government needs to keep calm and let the rupee move a little. If it does, it's going to raise concerns about imported inflation. So it's a challenge and it's not easy. But that's how we can actually stay the course and remain
Mhm.
stable
Mhm.
for the next through the next year.
Keep calm is a message Ela has been reiterating again and again, and we will use one more opportunity to do that today. So there are three challenges, but I will go back to summarizing the five takeaways we talked about today. The economic service forecast for GDP growth in 22-23, its inflation concerns, its agile approach analysis of what helped the Indian economy. Number four is the fact that there could be investment and expansion in the budget based on tax revenue collections in the last year. And the last one is that macroeconomic indicators show that Indian economy could be stable in the next financial year. Thank you, Ela, and thank you so much for watching this special live edition of Elanomics. We will be back again with another special live edition tomorrow. Tomorrow is the budget, and we will come live very soon after the budget. We will announce the timings on Twitter, so please do track our social media handles. And